Good afternoon, and thank you for joining us for the second of the Kearney Group market updates. Today, Thursday, 8 September 2022. My name's Matt England, and I'm the Chief Operating Officer of the Kearney Group. I joined this meeting today from Orange in Central West New South Wales, which is my home. Orange is situated on the traditional lands of the Wiradjuri people. I'd like to acknowledge the traditional owners of the land and pay my respects to elders past, present and emerging. I'm pleased to be joined today by two experts in the market. David Wright, the CEO of Zenith Investment Partners. David's joining us from Wurundjeri country, the Wurundjeri Wurrung peoples. And Anthony Doyle, Head of Investment Strategy at Firetrail Investments, who's on the Gadigal lands of the Eora Nation. Gentlemen, thank you for joining us today. It's fair to say it's been an interesting month in investment markets and more broadly, an interesting 12 months for our investors. Righty, I'm going to come to you shortly. Let's have a quick recap of the themes that have played out over the last 12 months, but to set a scene for that, returns have been pretty negative. Australian shares to the end of August off 3%. Global shares hedged, Aussie dollar hedged, off 13%. Aussie bonds, the supposed safe haven, off 11.5%, and global bonds off 10.5%. Mate, what's been driving it?
Well, I guess you're right, Matt. It hasn't been a happy time for investment markets, and obviously returns from markets, and obviously for the Kearney portfolios, across all portfolios, not just obviously the Kearney Group. I think we do have to put things into perspective a bit. I think last time we met, Matt, we spoke about the really strong rebound that markets had post the big COVID drawdown. And so we really did have some pretty spectacular returns, really from what April or so, March, April or so last 2020 to, halfway through last year, perhaps a bit further than that. I think when markets are moving around so quickly, some of the things I'm going to say feel like an eternity ago, but are really, as you say, what's happened in the last 12 months. And the key one, of course, has been inflation. So inflation has reared its head, really strongly, both here and in the US market. And, what that's led to very much is the central banks really trying to get on top of that, control it, and bring it back to more what we call sort of neutral and manageable levels. So that's spooked markets, because what that requires, as we've seen here, and the same thing is going on certainly in the US and other parts of the world, is increasing official interest rates. Markets generally don't like that. So that's led to the sort of negative returns that we've seen. And you sort of, what's played into the inflation, of course, as well, is things like the Russia-Ukraine crisis, which again is still kind of playing out. It's interesting, isn't it? We saw a lot of press day after day after day when the conflict first started, and there's not a great deal of it now, and yet it is still playing out in the background. And so initially, and certainly for a few months thereafter, we had energy prices and the disruption, given that Ukraine is such a big supplier of energy to Europe, energy prices going through the roof and kind of energy-related stocks going through the roof. We've had China lockdowns that affected the ports of China, and many of you might have seen, literally the thousands of ships docked in and around Shanghai Harbour waiting for those lockdowns to end. And then more recently, I guess, the kind of China-Taiwan, I suppose chest beating by China around Taiwan from Nancy Pelosi's visit from the US. So all of these things have played into market volatility. Most of those things, with the exception of the last one, have certainly played into inflation.
Yep.
So the cost of energy in Europe is still very high. So too the China lockdowns and the port kind of lockups created further exacerbated the supply chain challenges that we've had coming out of COVID. And so the shortage of goods has led to prices being bid up for, goods, which is fed into that inflation pressure that we now have coming out in the official numbers. So that's kind of what's driven markets. And just a reminder, Matt, that for everyone listening, markets are forward-looking. So, we've heard things about a cash rate or increases in interest rates leading to recessionary conditions or recession. We're not in a recession. We saw the GDP numbers for the June quarter come out yesterday, still relatively strong. I think, Anthony, we might speak a little bit about consumer sentiment kind of tipping over in terms of measures, but in terms of spending, that hasn't yet hit. Consumer spending is still, pretty strong, and some of the stocks, Anthony, that have benefited from that. So we're not in recession, but markets are forward-looking, Matt, as we know. So really looking at what's likely to happen in 6, 12, 18 months' time.
Fantastic summary. Thanks, David. We'll probably touch on each of those themes in some order, if that's okay. Anthony, if we come to yourself, thanks for joining us today. The reporting season here in Australia, obviously a very important time twice a year for markets and for investors. A whole bunch of stocks not long from now or recently going ex-div. What can you tell us about the reporting season that's just concluded? Who are the winners? Who are the losers? What were some of the themes? And just for the audience, we've got a whole bunch of slides that our presenters might ask us to go to. James Lewis, my colleague and friend, is driving the technology for today. So if you hear the gents ask somebody in the background, James, to go to a slide, that'll be what's going on.
Yeah, thanks very much, Matt, and thanks for that great summary, David, as well. So if you want to just move to slide number 15, James, please. Just this short slide on the Aussie earnings season wrap-up that I think really condenses our views of what's going on at the moment. First half of the year, absolutely dominated by fears over rising interest rates and central banks' willingness to stamp out high inflation. Arguably, a big debate going on at the moment. What impact can rising interest rates have on things that are supply constrained, like commodities, like energy prices, for example? That's a debate probably for a little bit later. But the concerns now, looking forward, as David mentioned, is very much, will we be entering into a recessionary environment over the course of the next 12 months? So in terms of the earnings that we saw, of course, they're backward looking, but they were better than many had feared. So we had 30% of companies actually beating consensus expectations for earnings and around 27% missing. Consumer spending has absolutely been resilient, as David mentioned, but it's interesting to note that many consumers actually haven't felt the impact of rising mortgage rates and rising interest rates yet. The reason for that is there is a lag to which the banks will pass on higher interest rates via mortgage costs of about 3 months. So remember that monetary policy and higher interest rates, they will impact the outlook for consumer spending. Of course, confidence has deteriorated. The housing market, the great topic at any barbecue you go around Australia, whether you're at Orange, whether you're in Melbourne, whether you're in Sydney and beyond, the housing market has definitely slowed. And I like to look at auction clearance rates as a determiner of where prices may go, and they're indicating further declines going forward as well. And of course, if mortgage rates are increasing, then the capacity to borrow is less for new home buyers as well. So confidence is lower. The great news is household balance sheets are robust. Consumer spending hasn't slowed down yet, but we're watching very, very closely to see if that occurs. Many companies are reporting to us the impact of rising costs and that feeding through into their balance sheets as well. Unemployment is at almost record lows, only 3.4%. So higher wages and even just trying to find staff. I'm sure you walk around and every second shop seems to have a job advertisement in their window. Interesting this week, the Dan Murphys came out and said, come into our store, meet the manager, and you will get a job interview within 10 minutes. ahead of the Christmas rush. So costs are certainly rising. And that said, so we've seen a big focus on balance sheets as well. So certainly, I mean, I think post GFC, even really, looking more closer, post COVID, it was really easy to make money in this market. Interest rates were falling. Central banks were stimulating heavily. Governments around the world were supporting their economies by fiscal spending as well. So you could be quite lazy and do well in equity markets. Going forward, there's much more dispersion. And I think this really plays into doing your homework, fundamental analysis, and really trying to identify those winners from the losers. So I've got a few anecdotes for you here from what we've seen. So the tech sector has been really hit very hard, particularly small caps. So one interesting example of that is Appen. So they are a digital maps provider. Their share price has fallen from $37 to $3.64 after profits fell more than 60%. And the downturn has been much worse. And that is familiar story for many small cap and tech names. A COVID beneficiary, Kogan.com. If anyone was at home in lockdown last year, bought something off Kogan, I know I certainly did. It hit $25 a share in 2020. Today, it's only $3.50 and reported a $36 million loss on the back of fluctuating consumer demand and wayward stock inventory control. On the other side of the coin, a company like WiseTech reported a 25% uplift in revenue and a 71% increase in profit. So that goes to show you, you can't just throw the baby out with the bathwater here. There are certainly winners in every single sector. In terms of the banks reporting very low loan loss provisions, I anticipate that we'll see default rates begin to increase. But that's probably a story over the course of the next 12 months rather than one for today. And of course, the mining sector is absolutely having a wonderful time with that focus on dividends. So going forward, the market expects earnings growth. So share prices typically follow earnings growth of around 7%. We think that's pretty optimistic. We think it's closer to 5%, which is around the long-term average. And once you put in your dividend yield of around 4.5%, you're looking at high single digits returns for equity markets over the course of the financial year 2022-2023. In terms of equity markets, the Australian equity market in particular.
Fantastic, Anthony. I'm going to stop you there for just one moment. I want to remind everybody that I neglected at the start. My apologies, clients and colleagues and friends. This is general advice only. James, can you just bring up the general advice warning? We'd love to give you personal advice, folks. Please make sure you make contact with myself or with the team with the details on the slide if you would like an update to your personal circumstances. But we are talking general advice in this particular presentation. Thanks, mate. Let's go back to Anthony. So we're high single digit returns or mid single digit returns for yourself for the forward markets for the Australian. Righty, if we turn our attention to global markets had a pretty cracking July and a pretty terrible August, tipped off by a speech by Jerome Powell, the Fed chair. Mate, what did he say, and why did the markets respond in the way they did to his speech at Jackson Hole?
Yeah, you're right, Matt. And that speech has been characterised. I saw a chart the other day by the fact that it was the shortest by a head of the US Fed, I think, at the Jackson Hole convention ever. And what he did say was pretty powerful, and that was that, we will get on top of inflation, essentially. Paraphrasing, but and we'll do what's needed to do that. So I think we did see prior to that, Matt, just in the month before, the US CPI did seem to moderate slightly. And so the market took that as an indication that, perhaps the US Federal Reserve, which is the equivalent of our Australian Reserve Bank, would not have to raise interest rates as much as first thought. I think, as you said, so July was very strong, and in fact, even the start of August was continued that strength. And it wasn't really, as you say, until that speech that the market kind of took a breather and reflected and thought, okay, well, it looks as if they're going to go as hard as they need to really bring that inflation in check. So, as I said before, markets tend not to like higher interest rates, and if the view is that those interest rates are going to be higher than they kind of were not initially first thought, but had hoped for post the moderation in CPI, that's really what's led to the greater volatility over the last couple of weeks.
Yeah, absolutely. There's a couple of things that have gone on more recently. If we, David, you spoke to the Russia-Ukrainian conflict that obviously continues to impact markets at the moment. During the last couple of weeks, maybe the last week or so, Russia's Gazprom, the largest supplier of gas and oil, has actually suspended supply of gas through the Nord Stream 1 pipeline to Europe. Anthony, David, who wants to pick up on that one? Why did they do it? What will be the impact for it? And for a new UK Prime Minister, Liz Truss, what do you think her response will be? And then the market's response to her response to Gazprom's behaviour. Who wants to pick that one up?
Well, I might just maybe pick up part of it and leave some of it for Anthony as well, Matt. But we were just speaking to some of our colleagues in UK just yesterday. And this is, as I say, something that we don't necessarily get the full feel for or understanding here. But they are very, very concerned about the cost of energy prices in the UK and what that means for the average consumer, let alone the business sector. So it is, as I say, we don't get that kind of press coverage and message here. So it is, as you said, going to be a baptism of fire, unfortunately, for Liz Truss and starting the new prime ministership. That's kind of front and centre of the concerns in the UK and obviously broader Europe at the moment.
Yeah, I lived in London for 10 years, so I returned to Australia in 2018. So I've always kept pretty close with what's going on in the UK and Europe, having been there for so long. And to just give you an anecdote in terms of what David is saying, the energy regulator in the UK has allowed energy companies to pass on 80% increases to energy prices to UK households. And in terms of gas supplies into Europe, into Germany, the Germans have come up with a rationing plan. Households won't be impacted in terms of there will be caps on energy price increases, but industrials are not immune. So industrials, they can pass on the full increase in electricity and energy prices as well. You're also hearing stories, particularly heading into the winter, that in terms of the UK, keeping museums open, libraries open, universities open to incentivize, or to people that are at risk can go and keep warm. And even in Germany, you're hearing about people returning to the office just so that they can get air conditioning in the record heat wave as well. So it is truly astounding what's going on in the UK and Europe. It's very difficult to try and make money out of geopolitics. I learned that in Brexit, when certainly it wasn't the consensus that Brexit would occur in that referendum. Even the election of Donald Trump as well, markets got it so wrong. So it's very, very difficult. It's not what we do at Firetrail. We obviously try to understand the risks. But certainly, we were talking about wheat prices this morning, and Russia are allowing the Ukraine to export 80% of their wheat abroad. And I just questioned the analysts, why are they allowing that to occur? Aren't they at war? And it was just, don't know. And certainly they're playing shenanigans with Nord Stream gas as well. So it obviously suggests, the Bank of England came out with the most downbeat outlook from a central bank ever. 2 years of recession in the UK. Inflation expected to peak at 13%. It's currently 12.1. interest rate increases coming through, the cost of living, it is very, very difficult. That said, as I mentioned, and as David mentioned, markets are forward-looking, and often what you find is that markets perform best when things go from bad to less bad, and when sentiment goes from very, very poor to less poor. So we don't think that this is the time to be retreating out of some of those global positions that we have. Indeed, we're finding excellent opportunities, but it is certainly a very, very difficult geopolitical environment.
I think if there is a positive spin on the kind of energy or crisis from a pricing perspective, Matt, as you know, is that it has put further momentum and on clean energy. Yep. And as we know, the Ethos portfolios play into that thematic. We do have infrastructure that and an infrastructure manager that plays into that space. So the acceleration of the move to clean energy, and we talk about wind, solar, kind of water, that type of thing, is undoubtedly sort of well, as I said, accelerated, and there's further momentum around that, as there is around concern for climate change or carbon emissions and climate change issues.
Yeah. So James, if you just pull up slide number 23, I'll just bring it to life for some of your clients in terms of some of these opportunities that I talk about. So one company, Carrier, is a heating, cooling, and air conditioning company. Because of high energy prices, the focus now is very much on energy efficiency. So a new air conditioning unit is 30% more efficient to run from an energy perspective than an existing unit. So you obviously get lower carbon emissions, but because of high energy prices, in terms of the break even of installing a new air conditioning unit, it's halved in the UK and Europe from 6 to 3 years. So you get the energy efficiency gains, you get a new air conditioning unit. And in terms of the heat wave that London just experienced, the 40-degree days, 9 out of the last 10 years have been the hottest on record in the UK. And only 5% of UK households have an air conditioning unit installed. Similar statistics for Europe. So we anticipate that in the US and in the UK and Europe, we'll see a raft of air conditioning upgrades in commercial and residential properties, and Carrier stands to benefit from that. On the renewable side, there's a company there called Darling Ingredients, domiciled in New York, the New York Stock Exchange. They're actually based out of Texas, but they make renewable diesel, a 100% substitute for traditional petrol diesel. And the life cycle of this product, 95% fewer carbon emissions, plugs straight in. You can fill your Toyota Hilux Ute with this product, renewable diesel, made entirely from used cooking oil and animal offcuts. So they're relatively insulated from the food versus fuel debate. So that's a couple of examples of companies that we have exposure to that in the current environment are resilient and growing their earnings, and we should see the share price appreciate on the back of that. And of course, this is for illustrative purposes only, as Matt said earlier.
Thank you for that, Anthony. I remember seeing an episode of The West Wing. For those who know me well, I love The West Wing. And in that episode, what must have been 15 or 18 years ago, they were talking about renewable energy coming from food and animal offcuts at that stage. It's a little bit like The Simpsons having such a prescient view of the future. Maybe we should look to see what's going on there. Going on with Russia and China at the moment. Vladimir Putin and Xi Jinping obviously are due to meet in Uzbekistan over the course of the next week. It's the first time since they announced their no limits partnership. What's the market saying about this? Is there any concern broadly in equity markets about this particular tie-up, or is it actually giving some level of credence to the likelihood that there'll be stability across that part of Europe and East Asia for a period of time? And David, Anthony, any thoughts?
Well, I think certainly from China's perspective, and we talked earlier, Matt, about the importance of China to Australia, and that they certainly do remain important. But what's perhaps not that well known by many of your investors is that China as we know, do have a massive population, but it's an aging population. They're sort of paying, in some ways, paying the price from the one-child policy. And so much of their growth, over the last 2-3 decades has been driven by the rise of the middle class in China. However, going forward, going forward, they are very reliant on the rest of the world, buying their products and services. And so whilst, as we saw with as I said at the outset, the kind of Taiwan shenanigans and sort of chest beating over that, we don't feel China wants to upset the global developed and emerging markets world very much, because they rely on them. They rely on us. They rely on the big developed countries. So not sure what will come out of those talks, but I mean, as Anthony said before, very hard to invest based on sort of geopolitical forecasts. But, we're kind of optimistic that China's not aggressively going to, rattle the cages of the developed and for that matter, emerging markets world.
Fantastic. If we turn our attention now briefly to Australia and the way in which the RBA is going after inflation, and then we're going to turn our attention to the positioning of the portfolios. And when we do with that, David, I'm going to start with you with some of the data you've got around how portfolios accelerate or markets accelerate off the back of periods of underperformance like they have more recently. But if we start with the RBA and inflation, we touched on it briefly already. Another 50 basis points this week. The market's now pricing in continued increases, maybe another 50 or so, I think. One of you might correct me on that one. Where does the market see the tipping point coming? Question one. Question two, what faith is there in professional investment land that the RBA won't push too far and tip us into either a technical or a full-blown recession? Maybe Anthony, if I could start with yourself on that one, where does the market see the RBA pushing to, and then what's the house view from Firetrail around the risks of going too far?
Yeah, sure. So James, I've got a few slides on this. Slide 17 to start with. So in terms of the market's expectation for further interest rate hikes, the market expects that the RBA will approach 3%, a neutral level of interest rates, currently at 2.35, and is debating currently whether we'll see a step down in the rate of increases from 50 basis points, 0.5% to 0.25%, from now until the end of the year. So that's the question mark. And when I read the RBA statement on Tuesday, it was pretty clear that we're getting closer and closer to a point at which they will slow down the rate increases. And they want to see what the incoming data will tell them about the outlook. Now, unemployment and the labour market is famously a lagging indicator, meaning it's more backward-looking than forward-looking. But as I mentioned earlier, if you can get a job and pay your mortgage, that bodes very, very well for economic growth. So we do expect that consumer spending will remain relatively resilient. We expect that interest rate hikes will begin to bite. But don't forget, it's all a relative sense. So we're coming off an absolute emergency level of interest rates of 0.1%, quantitative easing. We had yield curve control. And it's right that in the current environment of inflation of over 6%, expected to increase to 7.5% by December, it is right that interest rates move higher as a result. But again, beware of the very bearish news cycle, because obviously news outlets exist to get your eyeballs, and it's typically fear which will dominate investors' mindsets, and they will sell at absolutely the wrong time. So in terms of slide 18, James, I just wanted to highlight to everyone where the inflation has been since the COVID crisis. And you can see electricity costs are the big outlier there. That, talking to the big energy companies, in Australia, electricity prices, energy prices are certainly going to come through in the quarters and months and years ahead. So that should switch. But certainly you've seen that consumers in Australia shifted their spending habits from one of goods to one from services to goods. But just look at those categories that have risen. You're talking about international holidays, domestic holidays, of course, cars, furniture. Australians have been spending like a drunken sailor. So it's absolutely right that we start to see some constraints come into household balance sheets. And the stuff that has traditionally kept inflation down low, that's actually turned into inflationary categories. Now, the important thing to work with Kearney Group on is that inflation is a general measure of the price of goods and services in the economy, and to assess your own cost of living and what is an appropriate investment stance for your own cost of living in terms of an appropriate investment portfolio. And finally, slide 19, I want to highlight just in terms of a long-term outlook, how good, if you're looking for inflation, a hedge against inflation, typically equities have performed very well over the long term, as you can see. But again, we often get caught up in the day-to-day noise, as I mentioned earlier, and trying to predict what the stock market will do by the end of the year. We think that if you can filter through the noise, focus on what matters, and try and identify companies that are going to perform well over the next 3 to 5 years, you stand a very high probability of meeting your long-term investment and savings goals. So on the left is a chart of the Australian equity market, including dividends, so accumulation versus inflation since 1980. And on the right, this shows you the probability of returns, extending your time horizon. So over 1 month, historically speaking, 64% of observations were positive and 36% were negative. And you can see that really tails off. So anyone that invested in the ASX All Ords since 1980 with a 7-year investment time horizon, every observation has been positive if you had a 7-year minimum investment time horizon. And even 3 years, only 8% of observations were negative in that sense. So the RBA, yes, they will increase interest rates. Yes, they might move them to neutral or restrictive territory. We may see a global economic slowdown. Indeed, we are. But Australia has been relatively well insulated from that, given the strength of household balance sheets, high commodity prices, and low unemployment.
Fantastic. Thanks, Anthony. Our clients are certainly younger and healthier than the average, so they've got lots of time on their side, which is fantastic, but it doesn't make the more recent market movements any easier. David, before I come to you to talk about will the RBA be able to walk that fine line between bringing inflation under control and not tipping Australia into recession, probably worthwhile reminding our audience that you are able to ask questions. All you need to do is flick a quick note through, and we'll bring that to life with our expert panel here. So, David, do you think the RBA will be able to tiptoe through, given so much of the inflation we saw from Anthony's stuff? Some of it's about consumer discretionary, but lots of it's actually thematic, which can be impacted obviously by changing interest rates, but some of it's thematic about supply chain issues or more global themes. How will the RBA go tiptoeing this particular line, do you think?
Well, I think it's a great question, Matt, because let's face it, there is or has been some lack of confidence in the RBA, given that, the Governor, Philip Lowe, mentioned at one point that there wouldn't be interest rate increases until 2024. And so, well, absolutely. And I think, rightfully so, some people could feel a little cheated if they've entered into the housing market on the back of some of those comments. And we have also got, a number of people, politicians, academics calling for a review of the makeup of the RBA board, which may or may not occur. Look, it is a fine line, as you said. I mean, I do think, as Anthony said, there's no doubt there'll be further interest rate increases that will act to bring down demand. to some extent. We don't know how strongly yet, and that'll certainly help. As to getting that absolutely right in terms of bringing inflation to manageable levels, and yet not stopping the economy. That's a tricky business in every one of these cycles. And to be honest, the Federal Reserve and other central banks face the same thing.
Yeah.
As you mentioned, and I think there's some great kind of lessons out of what Anthony mentioned. Absolutely. So, James, if maybe we show slide 7. This chart. Yeah, thanks, James. This chart really, it's pretty busy. What's that?
It's a beautiful chart.
It's a busy chart, and it's for the audience, what it's showing is all of the market corrections in the kind of post-war era. So I think there's 8 of them there, and we're defining a market correction by a fall of the in this case the US S&P 500 by more than 20%. So that kind of 0 point, and the right-hand side of the chart is really showing what's happened since then. And if we look at where in the current kind of environment, the S&P did at its low fall kind of 21% from its high. What this does show is that markets recover. And again, I think Anthony kind of touched on this. There's a couple of exceptions to that. The most obvious being 2001 and 2008. And if you remember, 2008 is really sort of the global financial crisis. Those 2 cases where the market didn't rebound as strongly were really characterized by, what in the industry we sort of call, structural bear markets. And they're characterized by company balance sheets not being in a strong position. So generally, high levels of debt would be one of the key criteria there. Anthony mentioned we're not in that position this time. In fact, for the most part, and clearly not everywhere, but for the most part, companies are in pretty good fiscal or balance sheet position. And so that, if we take any lessons from history from that, that's more akin to a cyclically driven bear market, and they tend to be shorter lived, not as deep, and faster to recover. So we kind of feel like that's the environment, that we're in currently. If we go to the next chart, James, this is stripping out. So a lot of people sort of say, yeah, but how many of these markets were in high inflationary periods? Given that we haven't had high inflation since the 70s and 80s. And so we sort of strip those out as well. And you can see in all but one of the cases here, being the sort of 74 market correction, that the markets have recovered, strongly post that correction, even in inflationary periods, with the exception being the 74 one, which was, for those of you that may remember way back then, it was the kind of oil crisis, oil price crisis. So, again, it's very hard to time these things, and in fact, virtually impossible. So staying the course and letting those time periods that Anthony spoke to and really play out for you is very, very, very important.
How do you hold your nerve, David, in this sort of environment? So obviously you and Anthony have the benefit of being long-term investors. Our clients have the benefit of great quality advice. Do you have any recommendations around holding nerve? Looking at history probably helps. Any other tips for you? Well,
the other one really, and I'm just trying to see, it doesn't look like we have included that. Well, the one that at the moment, in a very uncertain environment, Matt, I mean, one of the keys we think from a portfolio construction perspective is to be highly diversified.
Yep.
And so we've got that through the Ethos portfolios, as you know. So we've got some inflation protection, through infrastructure, through some property securities, through some banks, as Anthony sort of spoke to. We've got we've got active managers like Anthony in the Firetrail team, and I think, and you can almost see it in Anthony's presentation here, that for a long time, as he said, to be honest, a lot of rubbish stocks rallied. And so for active managers, that was a really frustrating period because, they weren't being rewarded for identifying the better companies within portfolios. That has completely changed, as Anthony said. The market's broken down, the correlations of stocks have broken down, and the market's rewarding, those companies that are going to do well in the environment going forward. So, we've got that within the portfolio. So I think what can tend to happen with a lot of unadvised investors, to be honest, is that in times of uncertainty, they actually reduce diversification. They come back to the stuff that they know, Aussie property, term deposits, and maybe some Aussie shares. I mean, to be honest, that's almost the worst thing you can do, in our view, in this environment. You want a lot of different cannons firing in terms of generating returns and helping to protect your capital.
Very good advice. General advice, of course, but very good advice. David, the Ethos portfolio did take a hit over the course of the last 12 months. It was not long traditional energy, when traditional energy rallied pretty hard and had a small caps bias. What do you see for that over the course of the next couple of years? I know that my sense of these things and our broader discussions is that as markets return, then small caps, whilst more volatile, when they're leaning into the new emerging technology, tend to rally hard, particularly for those that are good quality, not that are actually revenue positive, or better still, profitable small cap players. And obviously energy, you spoke a little bit about. Anything to add to that in terms of Ethos portfolio positioning at this stage?
Yeah, well, I just think two things, Matt. The Ethos portfolios play into some very powerful trends and thematics. One being the whole move, to greater ESG, environment, social governance practices. Yeah. We're seeing that, and I'd be interested in Anthony's view on this, whether, we do think we're seeing companies that are following better practices in that space being rewarded with share price appreciation. As I mentioned, like climate change, with clean energy and so forth. But the small caps, and again, James, maybe if you could go to slide 10, and again, this plays into what Anthony was saying about timeframes. So it is the case that in market corrections, there's this so-called kind of flight to quality. Now, we wouldn't necessarily say big equals quality, but a lot of the market sort of sees big as being quality. So you'll often see things like small companies sold off more heavily. And what this chart shows is that whilst that is the case, as opposed to, so you've got the small ords here in blue and the ASX 200 in the orange, is that they do recover better over time as well. And that's why you're investing in small companies. They're generally not as mature. And so the growth profile and the volatility profile is higher. So, we have that positioning in the Ethos portfolios. It has been a position that has paid off handsomely over, medium and longer term periods. So yes, we understand there's some pain in the short term when markets sell off, but really important to sort of hold the nerve and benefit from the strength of recovery that that small companies do historically provide.
Fantastic, gentlemen. That brings us to 50 minutes or thereabouts. Are there any last messages you'd like to leave the audience with today?
I mean, for me, just to reconfirm what David was saying, that sustainability thematic is so powerful. So around 35 trillion of assets globally are invested in an ESG way today. So that's 40% of global assets. That's expected to increase to 60% by 2025. So sustainable businesses, they earn premiums in the marketplace. And we think you can deliver excellent performance by identifying those companies that are moving up the sustainability spectrum. So traditionally speaking, if you're a company that's been lowly rated on ESG and you improve that, you typically outperform the market over the course of the next 12 months. So sustainability, we think it's so powerful. We built a whole fund around it, only launched last year. I'm very happy to receive a recommended rating from Zenith as well on that. But it is a difficult environment, no doubt. Things could get worse before they get better. Typically, thinking about how to build long-term wealth, think about extending your time horizon, be diversified, and have a good level of cash as well, so you're not a forced seller, would be the conversations that I have with advisors around Australia. And I'm sure Kearney have certainly got some excellent views on that as well. But yeah, I think the best thing to do, Matt, is really go for a long walk, sample some orange wines, and not get caught up in the day-to-day noise too much.
I liked all of your advice up to and including that particular point. There's certainly some great companies up here. There are 52 vineyards and 52 weekends. There's no coincidence. David, anything?
Yes, and Holy Redeeming, an excellent restaurant up there too, Matt.
David Wright, anything to take us out with this afternoon?
Just mostly echoing what Anthony said there, Matt, and just to assure people that we do understand, it is a difficult environment. We do understand that's difficult for people when, their portfolio values moving around, but also assure that, collectively with you and the team at Kearney, we are constructing portfolios with many different levers to generate returns. And as I said before, try and protect capital. So, it really designed for people to stay the course. So important for people to stay the course. It is, inevitable, again, with people that are unadvised, they'll get out at precisely the wrong time and then not get back in, kind of early enough. Often some of the best returns are in the first part of the recovery.
Yep.
So if you miss that recovery, you miss the huge potential for better returns. So, just really, I guess, echoing what Anthony's mentioned.
Thank you both, gentlemen. Yes, I don't want to, whilst it's a lighthearted conversation today, I don't want it in any way, shape to be considered frivolous. This is incredibly important, we know, for our clients and for you guys as professional market investors, something we take our obligations very, very seriously on. I like the long-term thematic, recognise that short-term pain is here. For some of our clients, in the conversations that Andrew and Kevin and Paul and David and Jeremy have been having, it does highlight an opportunity to purchase additional assets in this particular point in time. But clearly those conversations are conversations that are about personal advice and the circumstances of the individual. Thank you both for your time today. We really appreciate it. Thank you to James Lewis for keeping us on track with this. We've had a couple of questions from our audience, but they're more of a personal nature, so we'll make sure we connect one-on-one with those individuals over the course of the next couple of days. Thank you very much for joining. We look forward to doing this again in a month or two's time. Good afternoon.
Thanks, Matt.
Thank you, everyone. Cheers.